Snap stock tumbled right over the cliff Monday evening, and the reason for the plummet makes it quite likely that Snap won't be the last tech company to see its shares go so spectacularly splat over the next few months. Less than 3 weeks after issuing guidance for the second quarter, Snap is now revising those figures, saying it expects both sales and profit to fall short of initial estimates. It blames the situation on a macroeconomic environment that has deteriorated further and faster than anticipated, the company says in a new SEC filing. Investors, already shaken by weeks of decline in equities, rushed to dump the stock in after-hours trading. Snap fell more than 30% to around $15.80, a grim mark for the shares. At such a price, it means the company has given up nearly all the gains it won through the pandemic, a time when users turned to apps like Snapchat to pass the time, lifting the fortunes of companies like Snap and other competitors. There are two narratives apparent in the stock's Wile E. Coyote imitation, and let's talk about them separately. There's the macro one, which is arguably the most important. Snap isn't the only company relying on digital advertising dollars to fill its bank accounts, far from it, of course. Everything from Alphabet to Meta does too. Snap's warning about revenue and profit should be viewed for what it most obviously is, an indicator those companies will struggle in the second quarter, and we'll get a look at just how bad it is for them when they report those figures in July and August. And after Snap's statement, the indicator alarm is glowing neon red, the same shade as, well, an illuminated exit sign. Which is precisely the directional cue investors across technology took on Monday. Meta shares declined 7% in after hours, Alphabet's by 3.6%, Pinterest's by 11.9%. And, yikes, this will only make things all the more dire for Twitter, whose shares dropped 3.9%. The further Twitter stock slides, the hungrier Elon Musk will get to redo his price for the company. If you have been living under a rock, and, my goodness, lucky you in some real sense, you may not know Musk offered $54.20 a share for Twitter as recently as April 14. It trades for $36.45 right now. In turn, if Twitter refuses to renegotiate, and Musk walks, which totally remains a possibility, Twitter will emerge out of takeover talks into a moderately to severely depressed market for ads with a share price that's a fraction of what Musk said he'd pay. Such a scenario is what you might metaphorically call out of the frying pan, into the bonfire. Even with a decreased appetite for ads among marketers, many big tech companies are going to do just fine, even if their shares take some hits in the next few months as they did on Monday and have overreached.